Alongside Brad Smith, this is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
Happy Monday to everybody. We did lose an hour of sleep this weekend, but hopefully you're all rested because we have a huge week ahead of us. Stock futures, we're tracking those now down across the board here this morning. Taking a look at the Dow, the S&P 500, and the Nasdaq lower across the board. This week, we've got two key inflation prints. You're going to get CPI on Tuesday and then those producer price indexes on Thursday. Plus, we tap into the state of the consumer with retail sales out Thursday and consumer sentiment out Friday. We're going to be tracking all of that for you right here on Yahoo Finance.
And that's not all. We also have a big data here going on. We have the earnings on deck as well. So we got big data, and then we've also got earnings. Let's make that clear. Software giants Oracle and Adobe to retailers Dollar Tree, Dollar General, and Kohl's. We're going to break it all down. The three things that you need to know this Monday morning, your roadmap for the trading day. Yahoo Finance's Madison Mills, David Hollerith, and Jared Blickery have more.
Stock futures are solidly in the red in the pre-market trade this morning, and this kicks off a data-heavy week to come. We're going to be getting that CPI print, jobless claims, of course, and the three major indices did close lower last week, so continuation of that sell-off. The Magnificent Seven so-called stocks, the darlings of the market, are lagging. 5 of the 7 ending last week lower. The declines in tech are now sparking concerns that markets may be poised for a bigger pullback.
Bitcoin notching another record high. The cryptocurrency briefly topped $72,000 for the first time, surging for a 6th straight day. Bitcoin has rallied over 60% so far this year, bringing smaller tokens like Ether and Solana up with it.
And Reddit is officially setting its sights on an IPO, the social media company looking to raise up to $748 million at $6.4 billion valuation, listing under the ticker RDDT. Now, Reddit warned in its filing of possible volatility in the market price as it sets aside over 1.7 million shares for certain users and moderators on the platform.
Well, good morning. The S&P 500 and the Nasdaq both recently setting new record highs to kick off the month of March. But after choppy trading in recent months and sessions here, I should say, correction concerns are emerging. To break down how investors might want to position themselves ahead of a potential pullback, we have Brian Belsky, BMO Capital Markets Chief Investment Strategist. Brian, great to have you here with us this morning. Always looking swagged out as always. Brian, first and foremost, when we think about what this setup looks like going into the economic data this week, and then of course, I guess I'll say it, next earnings season as we're kind of rounding out this first quarter of the year with just a few weeks left.
Thank you so much for having us. Humbled as always, and good morning, Yahoo. I think people are so focused on this term momentum. And if I hear momentum one more time, this is a momentum, market momentum. The thing that we have, I think, the most concern about is there's so many people have been late to the party in terms of being bullish, becoming bullish. And whenever the market is chasing, whenever most market participants, meaning portfolio managers or strategists or economists, all of a sudden turn bullish, that has us worried. And then the icing on the cake is, the big bull on the cover of Barron's over the weekend. That typically and historically is not a good sign that everyone is kind of chasing things now. So, given the fact that earnings were good and earnings from our perspective are holding the market where they are actually in terms of where the market is, we do think that prices are a little bit ahead of themselves. People probably are not customary to hear that from us, meaning that we're basically labeled as permabulls all the time. But we really believe that the market could see a bit of a pullback, which would be very normal and very healthy. And then we kind of reset for the end of the year. And we do think we'll see continued new highs the second half of the year.
Brian, it's good to see you. So then what do investors do if they have exposure to the Mag 7? Is it just a wait and see type of scenario, or should they be looking to reduce some of their positions?
Well, we've had, Shauna, nice to see you and hear from you. We have the very good fortune of running portfolios for BMO Wealth Management, both in Canada and the United States. And we've taken some off the table in terms of some of those positions. And we published about this 10 days ago. For instance, we did take a little bit off of Nvidia just because we've owned the stock for 7 years and the stock has had a heck of a run, and we were a little bit more overweight than we wanted to be. And this is kind of classic portfolio management where you still want to maintain positions, but you want to trim here a little bit. This is in this world of yes, no, right, left, green, red. It doesn't mean sell the stock. It just means trim a little bit. And I think that's the kind of posture that most investors should be from a longer term perspective. To answer your question, I think the tech stocks are kind of the consumer staples now. So use the pullback in Apple to add more. Apple and Microsoft are kind of the consumer staple side of things, where really the growth is going to be from Nvidia. Let's call it, for lack of an AMD. But we do think that Google and Netflix too, from a communication services standpoint, remain very, very strong in terms of their growth trajectories. And I think the pullback and weakness in Google is a longer term buying opportunity as well.
When you think about trimming, as you were just talking about there, and then potentially that profit taking, being able to put some of those profits to work elsewhere in the market, where else do you see some of those hotspots?
We think financials is an area that most investors, excuse me, on an institutional perspective, are way underweight. We do think that the Basel Accords will be a situation where you're going to see less regulation from the financials, where that could spur and fuel some consolidation, especially within the regionals. So we've long liked stocks like Citigroup, JP Morgan, Bank of America, Morgan Stanley, and Goldman. We think investment banking is going to be strong in the second half of the year. But I think where people are missing the most is in value stocks and small cap. This is not a call to be overweight value or overweight small cap. We think we need to be adding to positions, we as U.S. investors, because we basically left those areas behind, and so much focus is on the Magnificent Seven and tech stocks and growth stocks that we think value in particular is very timely. But small mid-cap stocks, from a cash flow perspective, earnings, and some of these names are actually paying dividends, are massively under-owned by investors. So a bit of a game of catch-up in the small, mid, and value, we think, is going to happen over the next 12 to 18 months.
Brian, there's been more and more talk just about, obviously, about what the Fed is going to do, whether or not the Fed is going, or when that first rate cut is going to be. Right now, we know the market's pricing in about 3 rate cuts before the end of the year. If the Fed, Brian, does not cut before the end of the year, what does that then mean for equities?
Well, I remember being in your studio and I was teasing you about the Smiths and reminding you that the Smiths was this great band in the 1980s. I was aging myself. But remember, we talked about this. What if the Fed doesn't cut? And we were talking about this in November. Everyone was way too focused on Fed funds futures this year. Fed funds futures have been wrong for 14 or 16 months. And so everybody thought we're going to see a cut in March. We didn't see any kind of analytical evidence from a fundamental perspective on why the Fed would cut in May. Our great economics department is still saying July. But, given the fact that inflation, and we'll get some prints this week, CPI and PPI, if it remains a little sticky, the Fed may be on hold longer than people think. And remember, we've reared an entire generation of investors that think they should only buy stocks if interest rates go down. That's not the case. We think interest rates and inflation and earnings growth and market performance in terms of stocks is in the process of normalizing. This is year 2. So I think we could see some, again, near-term volatility to the downside if the Fed doesn't cut, because everybody thinks it should cut, but we don't think it needs to cut.
All right, Brian Belsky, we're going to leave it there. We look forward to having you back on Yahoo Finance soon. BMO Capital Markets Chief Investment Strategist. Thanks, Brian.
Thank you.
Well, Bitcoin's record rally showing no signs of slowing, now topping $71,000 for the first time ever as more investors pour money into the digital asset through spot Bitcoin ETFs. Yahoo Finance's David Hollerith joining us now with more. And David, we talk about this momentum trade, the fact that it almost seems like nothing is going to be slowing down Bitcoin, at least anytime soon.
Yeah, that's right. And there are a lot of narratives out there about sort of the supply and demand dynamics, what's going on with Bitcoin. But as you pointed out, at the top of it is it's really still about the ETFs and just what kind of machine this is when asset managers start buying. So analysts sort of track how much buying happens. And you look at investment flows, there's been about $10 million of investment flows into these spot Bitcoin ETFs since they launched in January. And that translates to about 4,000 coins on average per day. And Bitcoin creates about 900 coins per day. So what's happening right now is just sheer supply and demand dynamics, as other guests have pointed out too. It's just that we're seeing huge amounts of demand right now. And it looks like there's going to be continued sort of demand stories coming out through the rest of the year or so.
And when we think about that demand story, I mean, some of it's going to be a larger international type of thread that we're going to have to draw here too. And we think about what just took place with the UK, and it looks like they're clearing the way for ETPs, Bitcoin ETPs, to come there. So how much of this is a global story as well of utilization, but also as an investment asset too?
Yeah, you know, the actual use cases for Bitcoin, which we're not actually talking about that much these days, are really around emerging markets and how it's going to be used. And that's still a pretty small amount of how much the asset's actually being used. So, you know, we're still waiting to see that. But really, as an emerging international currency is kind of the main story that Bitcoin bulls will talk about. So you got to see more of that to happen for it to really, you know, continue to have steam.
Dave, good to see you live in living color here in studio in New York. Thanks so much for joining us this morning.
Pleasure.
And another test is coming to the IPO market. Reddit's S1 filing out this morning showing it's looking to raise up to $748 million at a $6.4 billion valuation. The social media company issuing 22 million shares between a range of $31 to $34 per share. We'll see exactly where that price is right before the IPO, setting aside about 1.7 million shares for certain platform users. Now, this will be the first major tech stock launch of this year. So what should investors be watching for? We've got Greg Martin, Rainmaker Securities Managing Director, here with us. Greg, great to see you this morning. What should investors be watching for? What type of reception do we expect Reddit to see once they make their public debut?
Well, thank you for having me. Good to see you again. You know, this is an interesting one because, you know, we're getting restarted again, you know, especially in the tech sector. And I think a lot of people are, you know, heavily anticipating this one. You know, Reddit's going out with, I think, a pretty aggressive valuation. If you look at the comp set, you know, and their revenues last year were somewhere in the neighborhood of 800 million. And, you know, their comp set trades in the kind of the 5 to 7x range, and the company didn't really grow that much last year. So, you know, I would have expected them to be filing or more in the 4 to 6 range, and they're above that. And so, you know, they're clearly trying to sell, you know, an AI story. You know, they talk a lot about, you know, selling their data to large language models. They refer to a recent deal that they did with Google. So they're trying to differentiate themselves from who I think their comp set would be more like Pinterest and Snap, who I said, you know, trade more in the 5 to 7x revenue range. So I think they're trying to tell more of an AI story than just a media story. But the challenge they have is that 98% of their revenues are advertising. So it's going to be very interesting to see if they can really push, hey, we have all this data and there's more of an AI driven story here than just a regular, you know, social media story.
And Greg, they're also setting aside nearly 1.8 million shares for Reddit users. Now, that group will not be subject to the lockup period. I bring this up because what is that going to do to potential volatility here and what we could see once the stock opens?
Also very interesting. You know, I think that, you know, one of the issues that Reddit has had is that they've, you know, been private for a long time. They've been sort of this non-commercial place where, you know, people could talk about their interests freely. And of course, they created the whole meme stock platform with some of their stock forums. And I think it's something that they're concerned with. There was a little bit of the users were not happy in some cases. And so I think they're trying to placate their heavy users. They're trying to provide them with an incentive to sort of be positive about the stock and the company. And that's why they're giving them these shares, but they're going to create, as you point out, a lot of volatility. These are retail investors. They will probably trade in and trade out. Normally, you like to, you know, place your IPO with long-term holders. So I think we're going to see a lot of active trading, and, you know, Reddit is worried about being a meme stock on their meme stock platform. So I think it's something that we got to watch very closely.
Not just worried about being a meme stock, also worried about the reality of sustained profitability here too. And looking through some of the numbers, net losses incurred of about $158.6 million in 2022, and then trim that to $90.8 million in 2023. All these things considered, is Reddit a company that has positioned itself well enough at this juncture to enter into a market as an unprofitable company and investors be able to believe that they're going to reach that profitability and sustain it over the longer term?
It's a great question. Like I said, you know, the numbers, they aren't growing, you know, at a level that, you know, you would expect to see at 20%, as I pointed out. They're not profitable at this point. So there's some challenges that they're going to have telling the story. I think it's why they're so focused on, hey, we have all this data, we have all these users that are contributing this data. This should help any LLM train their models. It's unique, it's proprietary, and so a lot of what they talk about pre-IPO here is the AI story. Obviously Sam Altman's a significant investor, and Sam Altman is Mr. AI. So I really think they're trying to push that narrative. But the reality is, as I said, 98% of their revenue is advertising. They are a social media company. They ought to trade in a manner similar to Pinterest and Snap. And I think that's going to create some valuation challenges for them, especially since they're not profitable.
Greg, taking a step back, the success of Reddit's IPO, just how much is riding on this public debut when we talk about the potential for more tech IPOs in the pipeline this year?
Listen, it's definitely going to be closely watched. There's a huge backlog of tech IPOs. This is going to be really the first big one of the year. And so people are going to just want to see what kind of demand there is. Now, as I said, they're not growing that much. They're not profitable. Their story, while unique, is similar to several other social media stories. And so it doesn't jump out at you as being super different. But it's the beginning, hopefully, of at least we hope to see fairly stable and strong demand. We hope to see some reasonable aftermarket performance. I'm a little surprised that they're going with an aggressive price, because I do think the market needs to see strong aftermarket performance, and it feels like they're being priced to perfection. But we will test whether the AI story holds legs. We know that there's significant demand for AI type companies, and so if Reddit can cross that chasm from being just a traditional social media company to be more of an AI story, we know that's where a lot of the interest lies in the market right now.
Just lastly, while we have you here, Greg, is Reddit the IPO that is expected to open the floodgates, perhaps, as a test case for companies going public this year?
Well, as someone who has a vested interest in seeing the IPO market, reopen with some of my portfolio, I certainly hope so. It doesn't feel like the true shot in the arm, at least if I were projecting what the market will need. We have a pretty strong market, so there's a lot of other positive factors in the market that will hopefully push, successful IPOs to come. I can tell you that just the Reddit filing, just Reddit being on the road, has definitely stimulated a lot of other companies to push their IPO process along. So I do think that interest has already been created, but I think people are going to watch it closely, and I hope that ultimately they create a little bit of an IPO bump for their investors, and that the backlog of IPO-able companies really starts to open up. But I think it'll be a little more of a trickle. I don't think this will be the huge shot in the arm that everyone is hoping for.
All right, Greg Martin, always great to get you on here at Yahoo Finance. Thanks so much for hopping on with us this Monday morning.
Thanks a lot. Good to see you guys.
All right, coming up, we're taking a look at shares of Apple. You can see moving up just about 0.8% in the pre-market. The company planning to open a new Shanghai store as China iPhone sales slump. But what's it going to do to the stock price? How big of a catalyst could this be when we come back?
Time for some trending tickers. Let's take a look at Apple. They're looking to boost iPhone demand in China, now preparing to open its 8th location in Shanghai on March 21st, bringing its total to 47 retail stores in the country here. Now, this is amazingly important, and we're taking a look at shares of Apple, AAPL, up 1% here ahead of the start of trade on this Monday. Most notably here, though, it comes after Counterpoint Research had found that within the first 6 weeks of 2024, there were double-digit declines on a percentage basis for Apple and some of the other competitors within that region. So that, most notable, there you're taking a look at some of those specifics, and 24% decline that they had seen in year over year on that comparable period. But this is also a major year for the number of generative AI products that are expected to come into the smartphone market. IDC expecting 170 million shipments of generative AI smartphones this year.
Yeah, because of that decline that you were just talking about in the first 6 weeks of the year in terms of the unit sales, we've seen Apple's market share fall below 16%. That was down from 19%. This is according also to Counterpoint Research there. And we know that China is so important for Apple's overall health, China accounting for nearly 20% of Apple's overall revenue. So we talk about decline in demand there and why that is so critical to the investment story surrounding Apple. Now, we know Apple is trying to change the narrative a bit when it comes to the share price here for the rest of 2024. There's been lots of talk about the push into AI, what that could potentially do in terms of driving that demand to the upside here. But Apple has certainly been an underperformer since the start of the year. Trouble here with demand in the U.S., also trouble clearly in China. So we'll see whether or not their plan to revamp or open new stores specifically in Shanghai is going to help boost that demand going forward. All right, well, let's take a look at another MAG 7 name, and that is Nvidia. Shares pulling back further in the pre-market. You can see it down just about 0.6%. It's been a wild couple of hours here. It had been trading higher this morning. Now, the chipmaker saw its biggest one-day loss in about 10 months on Friday, and that was enough to spook the broader market. We saw the pressure that then put on the S&P and obviously the Nasdaq as we closed out the trading week last week. And putting this in perspective, the drop that we saw on Friday at one point when it had been off just about 6% in intraday trading, 250 billion had been wiped off the stock in just about 3 hours. So that really puts the drop in perspective here for investors. BTIG out with the note saying that the consolidation in the AI trade has been overdue for a while now. Friday's key reversal day could signal some more of that unwind that could be ahead.
Yeah, I just think back to some recent history in our conversation with Brian Belsky just a moment ago, talking about how he was looking at his own positioning within Nvidia, trimming just a little bit here to start the year. And it's perhaps some of the behavior that's to be expected at this juncture. You've got Nvidia sitting at all-time highs right now, essentially over the past couple trading sessions, a little bit of profit taking, so taking some chips off the table, perhaps some rotation into financials, into healthcare, some of the other hot sectors like Brian was talking about and some other strategists have put in front of us as well and made their cases for. But now it's a larger question of, does Nvidia see an opportunity even for a stock split in the near future? What would that do for the retail investor out there? Does that make it more attractive than to pile more into the Nvidia trade, even though we've seen this massive run up at this point? So making it more affordable on a share price perspective as an entry point, but still, I think that is one area where if it was to hit $1,000, where we might hear a little bit more talk about that potentially.
Yeah, we have certainly seen that talk really start to escalate here, at least last week, just in terms of what that would do and the potential for that to actually happen. All right, we'll keep right here on Yahoo Finance. Much more of your market action. Had about 5 minutes to the opening bell on Wall Street. We'll be right back. Time for today's stock to watch, and that is Netflix. Oppenheimer feeling bullish on the stock, reiterating their outperform rating, boosting their price target. Madison Mills keeping a close eye on this from the floor of the New York Stock Exchange. Madison.
Well, Shauna, it looks like, according to this recent note that we have here, there's going to be an implied 20% gain for Netflix stock this year, and that's due to a price target raise to $7.25, so that implies a 20% gain. This is a stock that's already had a huge rally this year, up 24% year to date. If you look at the past 5 days, you are seeing some redness, but that might be an indication of the broader market themes. A lot of analysts saying that this is a stock that's going to be able to withstand any macro and stock market headwinds to come just because of the fundamentals here. So let me run through what you need to be looking at if you're looking at this name. It's two things here: subscriber growth and annual revenue per member. That's going to be things like moving around some ad tiered memberships to be able to increase market share, get as many users as possible, paying as much as possible. And we know that Netflix has done a great job cracking down on password sharing. If they're able to continue to do that and get more customers paying for no ads in general, that's going to be a boon for this stock moving forward.
All right, Madison, thanks so much for breaking down Netflix here this morning. Look, I, like many others out there, they might have been confused with Oppenheimer, the movie, but it was clarified very briefly here for me. Thanks so much. Appreciate it, Maddie. All right, that's the opening bell on Wall Street as we are just seconds away from hearing that bell ring. There you're taking a look at the New York Stock Exchange and the Nasdaq. You've got Ireland Inc. I didn't know that they were just incorporated like that. Good deal, though, for them. A lot of green on the screen here. It is the week of St. Patrick's Day as well, so.
There we go.
You got your green.
Kicking it off right.
Right, even if there's red.
A lot of green on the floor there, too.
Even if there's red on the major averages, we got some green guaranteed when Ireland Inc. is in town. And you've got some funfetti with Invesco QQQ at the Nasdaq. All right, so we've officially kicked off this trading week here at the mid-trading week, I guess, of March. We've got team coverage of the biggest market movers following the opening bell on Wall Street. Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange. Jared Blickery on standby at the Interactive. Investors are awaiting some key inflation data out this week. Maddie, what are you hearing around on the exchange? Have they set their calendars or set their notifications, their timers for CPI?
I mean, they're setting their notifications for your live show every morning, of course, Brad and Shauna, but it's looking like not a great morning, though. Obviously, all the major indices in the red here, including the Russell 2000, down 0.3%. This coming after the Dow's worst week since October last week. We know that we kind of broke off from this record-breaking streak that we've been having across the major indices, and that's partially due to our big leader here, Nvidia. As of last week, they'd been up around 19% over the past 5 days. They didn't continue to hold those gains moving into the close on Friday, and that's weighing on these stocks here, also pushing up the dollar. And of course, the big question here is going to be whether or not this is about the Federal Reserve. And that CPI print that you talked about is going to be really critical in terms of the market deciding and really pricing out the future of these rate cuts. Are we going to get one in June, or is it going to be a little bit later this year? Jay Powell has continued to be very clear in his language that they're going to continue to be data dependent. That's why watching tomorrow's CPI print is going to be so critical moving forward. I'm just taking a look. It looks like Nvidia is also down in the pre-market trade a little over 1%. If they are not able to push that up, that's going to be a difficult catalyst for the market throughout the day. I was also taking a look at volume this morning. Volume significantly up heading into the day, indicating a little bit of conviction in the kind of sell-off that we're seeing a little bit of. But I want to point out that my sources here are telling me this choppiness is normal. This is what happens after a record-breaking rally driven by a couple of names, so don't get too freaked out by the red that you're seeing today.
That is very similar to what Brian Belsky told us at the top of the show. All right, Maddie, thanks so much. Let's kick it over to Jared Blickery, who has a look at what we are seeing across the world. And Jared, there's a lot of red on your screen as well.
Yes, there are. I'm looking at Europe as well. And a quick note about Europe. United States has leapt forward here sprung forward for spring. But I don't think that happens in Europe until 2 weeks' time. So there's going to be this weird lag period where the time conversions are not what you're used to. Don't ask me to do the math on a Monday morning, but they are a little bit different for a couple weeks. Now, we're seeing a lot of red in the markets today, but NASDAQ is leading leading the way down about 45 basis points, a little bit less than 0.5%. And just checking in on the sector action, then we got to look at bonds in a second. Materials, staples, utilities are in the forefront, while tech is the biggest loser and the only underperformer, by the way, coming off kind of a nasty day Friday. And I want to take a look at the bond market because CPI is kind of is the tail that wags the dog here. This is a 10-year T-note yield. Now, we have not seen it under pressure in any direction, either to the upside or to the downside over the last 3 months. And that is actually good for stocks because bond volatility is good for stocks going up. If you take a look at the MOVE index, bond volatility going down, that is good for stocks. Also going to take a look at the US dollar index ahead of CPI. That is up about 12 basis points. And the US dollar has also kind of been in this sideways trading range as well. So it's not been pressuring markets either to one direction or the other. And then we got to take a look at the VIX here. The VIX is a little bit elevated relative to the last 3 months, but check out the last 2 years here, and you can see well in the bottom end of its range. Just want to point out that for tomorrow's CPI, 1/3 of the price gains in the S&P 500 from these October lows all the way back here, all the way up, 1/3 of those gains have been on CPI days. We just came off the last time a really bad print, a really bad reaction. So that could be a bellwether. We're going to want to pay a lot of attention to this print tomorrow, guys.
All right, Jared, thanks so much for breaking that down for us. Well, as we wait for that print, we're taking a look at stocks trending lower once again this morning. Further signs of the rally that seems to be losing steam. The Dow coming off its worst week that it's had since the start of the year. A lot of the losses being driven by the decline that we have seen in tech stocks. So what should investors do? We want to bring in George Perks. He's Bespoke Investment Group's macro strategist. George, it's good to see you here. So here we are starting the week again with the markets taking a leg lower. Is this indicative maybe of a larger pullback that investors should be expecting?
Thanks, Sean. Good morning. And yeah, I think one of the biggest things to remember in this leg lower we've seen since last Friday is that it's being led by the same stocks that led to the upside, which is the AI basket of stocks across tech, across communication services, and some consumer discretionary names as well. And that pullback is definitely long deserved. We've seen trillions of additional market value around the world added through the AI craze that has been running since ChatGPT was introduced. And so eventually those sorts of trades hit an air pocket at least. That doesn't mean that we're going to see them reverse entirely or anything that dramatic, and further upside gains are certainly possible, but what we're seeing is leadership to the downside from some of the same names that led the rally to the upside, which is what you would expect after the market has had such a strong run, and especially some sub-pockets of it, namely AI.
Do you think that this could initiate any type of massive wave of rotation into other sectors?
No, I think any big rotation is going to be driven more by macro factors as opposed to what's going on inside the equity market. So what we've seen over the past few months is that this boom in AI stocks has driven a large share of the gains. There have been big leadership from AI stocks, and some of them have gotten so large, whether it's sort of big name brand tech names or stocks that are newer in terms of being mega caps like Nvidia. They're so large now that they're driving an outsized share of the gains that makes the market look quite narrow. But there has been reasonably broad participation across the market. The number of stocks that are hitting new 52-week highs has been elevated versus history, and that's been confirming the move in price. And so when you see those two things together, you tend to see strong gains continue, historically speaking. I think if we do see a major change in tone from the Federal Reserve towards a more dovish monetary policy, that could start to kick off a more dramatic move across the market from some names that have been beaten down but haven't really participated in the AI move. So for instance, your real estate stocks, banks have also been performing quite well of late, despite some of the headwinds for smaller banks. There's a number of different sectors that look ready to rock higher if we start to see a more dovish pivot. So far this year, the Fed has really resisted that, and we'll see coming out of CPI tomorrow whether that's going to continue into the March FOMC meeting on the 20th.
George, if we do see a further delay in the rate cut, what is that then going to do for your positioning and what you expect then to outperform between now and the end of the year?
Yeah, I think a delay of signals around the rate cut from, the sort of two scenarios that are possible are saying, okay, we're teeing up a rate cut in May, which would be more dovish than where the market has been guided by the Fed so far this year, versus we're going to tee up a rate cut in June, which is sort of closer to current consensus. If we see the latter, so that is the Fed tees up a rate cut in June, signals through both the summary of economic projections forecast and through Chair Powell's commentary and the FOMC monetary policy statement, if they tee up, if they rule out May basically and say we're headed towards cuts, but we're not going to go at the next meeting, that won't necessarily be a huge headwind for the market. I think if the alternative is that they tee up May and say, okay, we're starting to discuss cuts now, and we're looking and imply that they're signaling May. That would be a very big positive. So I do think there's a bit of asymmetry around what the Fed is teeing up into this meeting. And it'll be interesting to see how markets sort of try to front run that based on whatever happens with CPI tomorrow.
Where are the areas that you expect the market to front run that, or where are the places that you expect investors to start perhaps cashing in on now and then preparing for where they could perhaps pile back into the market at some more reasonable valuations once we do see more firm signaling of a pivot from the Fed?
I think bond proxies are the most straightforward way to look at it. So your utilities, your REITs, and some consumer staples names that really tend to have long and very stable cash flows. Tech also tends to fall into this bucket, but it's in the last year or so, it started to diverge a lot from those bond proxies because of this dynamic of AI, which is this huge growth story that investors have grabbed onto. So all things equal, I would expect those sort of more defensive bond proxy type sectors to be where some of the best returns come if we do see a significantly more dovish than expected and more dovish than guided Fed over the past few months, when we get CPI data tomorrow and then when we actually get the March FOMC meeting next week.
Bespoke Investment Group macro strategist George Perks. George, thanks so much for taking the time here this morning.
Thanks, Brad. Nice to talk to y'all.
Likewise. Well, coming up, gold and Bitcoin both seeing a record rally, but is there more room to run? We're going to discuss that next.
Gold and Bitcoin both reaching record levels. You've got gold just around eyeing 2,200 level as investors becoming a little bit more optimistic about rate cuts this year. Now Bitcoin climbing above $72,000, that reaching that level for the first time ever. Let's talk about the massive climb to the upside and what's behind this record-setting rally. We want to bring in Ben Emmons. He is New Edge Wealth Senior Portfolio Manager, Head of Fixed Income and Macro, joining us now. Ben, it's great to have you here. So explain to us and the viewer here why we're seeing the record-setting run-up in both gold and Bitcoin at the same time.
I think it's all about supply, Shana, because in both cases there's very limited supply. And if you then have, let's say, uncertainty, which we may be dealing with a little bit currently, and a lot of talk about Fed easing, and they may go as soon as June, typically that gives gold a lift up. In the case of Bitcoin, it's about this halving event in April, and people calculated that although the final halving event is like a century from now, nonetheless, it's a limited asset class of supply. And I guess that if we're in an environment of liquidity, easing, and uncertainty, these two assets get lift up. And it's to be worth paying attention to because this is, I think, kind of a unique year going into the election.
Now, the price of gold also, as you note, has an inverse relationship to Treasury yield. So what's the anticipated kind of knock-on effect that we're expecting in correlation here?
That's an interesting point, Brad, because go back to 2011, that was a year of huge uncertainty. Debt ceiling, euro crisis, lots of things going on. And gold hit the first time its record high. And at that moment that happened, there was a lot of decline in treasury yields. Now, partly that had to do with what the Fed was doing, partly had to do with the euro crisis. But it was a kind of an interesting combination to see that about a decade or about later, during the pandemic, the similar event sort of happened. Record highs in gold and lower treasury yields. Again, Fed influence there, but similar idea. So we're back to record highs, maybe going even higher, and we're sitting with treasury yields pretty much at the high end of that range. So I'm wondering, like, if we're getting real uncertainty, as in, okay, we don't know who will be president, we don't really know if the economy actually stays this strong, all those kind of questions. You could actually see this idea of like high gold prices, low treasury yields. So it's something to watch.
Ben, what do you think when we look ahead just to tomorrow, the very short term here, the inflation print? What is that going to potentially do to activity here?
Well, I think it will be somewhat volatile because, the last inflation print, there was an expectation that headline inflation would go below 3%. That didn't happen. Since that time, we've had more energy prices going up. We've also had some data out on rents. We had some data out from the PCE and PPI data that all indicates stickier inflation. So there's an expectation that actually this print will not break the 3%. And why does that matter? Because ultimately it's about headline, right, for the consumer. If that were to really start declining, that would really change, I think, the perception about how much more the Fed could cut potentially beyond what they're saying now. Mm-hmm. And so I think we're sort of sitting here waiting like this number could be a little hotter given where the economy is. And also what's happening with energy prices, plus what during the testimony came out that they're also looking at high interest rates have also risen the cost of housing, which shows up in inflation. So it could be a hotter number.
In our Yahoo Finance Interactive across the studio, our viewers can't see that, but they keep tossing up Bitcoin from time and time out. And I keep taking a look over your shoulder at that. And at these levels that we're at, I mean, you're a very reasonable man, Ben. You're a marathoner. You're well calculated here. How high can Bitcoin go as you think about the scarcity that you were just laying out a moment ago?
Yeah, and this comes together with the demand for Bitcoins from these ETFs, as your colleague mentioned, like $10 billion or so got into those ETFs. And those managers have to buy the actual coins, right? It's no longer with futures or other proxies.
But that relies on people who already hold Bitcoin being willing to sell as well.
Exactly, and there's been limited selling, if not any. I mean, you could have websites that you could track the liquidation of Bitcoin. That's very limited, that's happened so far. Then you have this halving event, which again, that is actually slowing the rate of Bitcoins together with how it gets produced and mined. So it comes all together in one, and then I think that's a cocktail of then it breaks out above the highs, and how can it go? Well, sky is obviously the limit. My guess is it's gonna go probably like 100,000 or so. That will be your first sort of major milestone. I think don't be surprised that you actually reach that level.
So Ben, what is your advice then to investors out there? Should they tread carefully given the fact that the price of both of these assets is so volatile?
True, because let's face it, like the gains are extraordinary, particularly for Bitcoin. I think they've calculated from somewhere like more than 10 years ago, you had bought one Bitcoin, you've made like 7 million%. Will you make the next 7 million? That's volatility, obviously, right? So clearly, you want to be careful, but think about the long-term prospect of the asset as well as in gold. Why do these exist? Now, most of the institutional investors don't really play in that space until maybe now. That's, I think, one other force behind this, that it could go higher. Secondly, it is a diversification, because if you have that high of a gain or expect a return against where equity volatility currently is, which is really low, that is a possibility for diversification in a portfolio. So it has become a more serious asset, I think, ever since the SEC approved those ETFs. So, and given the institutional interest currently, this is becoming an asset that is a diversifying asset, scarce asset in the portfolio.
And is what's true for Bitcoin expected to be the same for Ether or Ethereum? Because now we've got applications lining up for Ether or Ethereum. That's still a heavy topic of conversation and contention. I won't wade down that route, but if we see ETFs come forward, if we see more utilization come forward on the Ether side, is what we've seen in Bitcoin in this run-up expected to be the same there?
So one difference with Bitcoin, with Ethereum, is that Ethereum has unlimited supply.
Right.
Because it's a gas, right? That's actually how it's created. But people looking at the correlation between the two, and people have always said, like, well, Ethereum is really the benchmark for blockchain technology. Mm-hmm. And that's, I think, the fundamental reason for the digital currency to exist, is that central banks may not go all to digital currencies just yet. Case in point, the Federal Reserve. But the implementation of blockchain technology is supported by central banks, and that supports Ethereum. So once that also gets approved as ETFs, you'll likely see the similar sort of interest from institutions and retail public to buy the ETF on Ethereum.
Absolutely. Ben, great to see you this morning. Thanks so much for taking the time.
Thank you. Thanks for having me.
And everyone, coming up on the other side of this short break, we've got much more Yahoo Finance Live. Stick around. Boeing falling this morning on a report from the Wall Street Journal saying the Department of Justice has launched a criminal investigation into the company. The DOJ is investigating that the incident that occurred in January when a door plug blew out of an Alaska Airlines flight, leaving a hole on the plane, forced an emergency landing here. And you're taking a look at shares of BA down by about 3%. It's not even just what the DOJ is going to be looking into. It's also how this is impacting some of the airlines more broadly here. You've got Delta Airlines. Even as the CEO told me, Ed Bastian told me on the most recent earnings results that he had full faith in Boeing, it still seems that there are, among all of the airlines that have orders in for any part of the MAX fleet, for Delta specifically, that's the MAX 10, which they had expected to be delivered by 2025. Many of these airlines, Delta included, now pushing out that timeline. Delta had actually also taken action in announcing an agreement for 20 Airbus A350-1000s with options for 20 more. Those, though, are also expected to begin being delivered in 2026 here. So this really just places even more of a capacity consideration in front of many of these airlines who are not just trying to restore capacity coming into last year and maintain that, but also making sure that their route schedules, they have enough aircrafts to deliver upon those route schedules too.
Yeah, certainly there are many headwinds facing Boeing, at least in the short term. We've seen that reflected in the stock price since the start of the year. You're looking at shares off since January 1st, more than 20%, off just about 26% year to date. The worst performer that we have seen in the Dow Jones Industrial Average. So putting that in perspective, and you take a look out here over the next couple of quarters, what is going to be the catalyst to turn things around? It seems like headline after headline is still laying out a very challenging roadmap for Boeing. Yes, CEO Dave Calhoun has reiterated the fact that he has full confidence in winning back some of that lost confidence that we have seen since the start of the year, really since over the last several years with all the unfortunate incidents that have happened surrounding Boeing's aircraft. But again, when you get comments like you were just talking about from Ed Bastian over at Delta, talking about how this could potentially impact the 737 MAX 10 in the future, a potential delay there, this could be an issue that may not be resolved now for some time to come, and could be an issue that continues to weigh on Boeing stock.
It has multiple prongs here too. It impacts the airfare prices at the end of the day too, especially if you're looking at some of the fleets not being able to have enough different routes that are coming on. So the frequency of the routes, it impacts the employment situation and the number of pilots that are expected to come on board. We already heard from one such airline, I believe it was United last week, that it said for some of the pilot entry into their workforce, they've now been holding off on bringing people fully in off of those training programs and whatnot. So employment, airfare prices, then of course the investor perspective as well here too.
All right, we'll keep right here on Yahoo Finance. Much more of your market action ahead. Again, you are looking at declines across the board. The Dow off just over 100 points. We'll be right back.
Hey, happy top of the 10 a.m. hour. Welcome back to Yahoo Finance. I'm Brad Smith alongside Shauna Smith. We're about 30 minutes into the start of the trading day. Let's take a look at how things are shaping up right now. First and foremost, markets bracing for the week ahead. Investors facing the final major test before the Fed's March meeting with February's Consumer Price Index report. That's out Tuesday. Data is expected to offer an updated look at inflation and inform the potential path ahead for monetary policy.
Taking a look at some of those individual trending tickers. First up, shares of Choice Hotels getting a boost here, up just about 5%. Jefferies upgrading the stock to buy from underperform. Now the move coming after Choice Hotels' decision to increase its stock buyback plan and also terminate its hostile bid for rival Wyndham Hotels and Resorts. And elsewhere in the hospitality space, Hyatt Hotels getting hit with a downgrade by Morgan Stanley. The flip side here, the firm noting risk reward is now balanced for Hyatt. Shares edging slightly lower here in early trading, off just about 1.5%.
And Jefferies shifting its stance on Pinduoduo, upgrading the stock to buy from hold. Jefferies raising their price target to $157 from $117, saying geopolitical concerns are priced in. Shares of Pinduoduo moving to the upside on the call by about 3%.
Duolingo getting a new recommendation on Wall Street. JP Morgan initiating coverage on the stock, an overweight rating, $270 price target. JP Morgan also listing it as a best idea in the education sector. The language learning software company rising in today's trading session, up just about 2.5%.
All right, BN. Well, investors are eagerly awaiting the latest read on inflation and what it will mean for the timing of rate cuts. CPI for the month of February is out Tuesday. The headline number year over year expected to remain unchanged from January. But core CPI, excluding volatile food and energy prices, is expected to soften a bit to 3.7%, slight decline from January's 3.9% reading. Here with more, we've got Citi economist Veronica Clark. Veronica, great to see you here this morning. All right, so the expectations are laid out. What, though, will this mean for the pathway for the Fed here, and what data dependency and the trend that they're looking for in that data is actually signaling?
Yeah. The most important thing that we're watching at 8:30 tomorrow morning is the month-on-month change in core CPI. So the year-on-year rate should be falling, but we're actually expecting to see still some residual strength in that monthly number. We're expecting a 0.33% month-on-month increase in core CPI. Now that's following a very strong January. I don't think we'll see quite a repeat of what we saw in January, but still some stickiness to services inflation in particular. And that's not a great place for the Fed, but we kind of have seen Fed officials talking about maybe this is just some bumpiness on the path to 2% inflation, and they do still seem to want to be cutting rates as we're getting to the middle of the year. So I don't know if this February number will quite clearly change that quite enough. They still seem like they're going to be cutting.
Veronica, what's your base case for rate cuts now?
Yeah, we're expecting that we're going to see the first cut in June. I think that's relatively consensus at this point. We're penciling in 125 basis points total in cuts for this year. So that is cutting in June and then every meeting after June. And it does, we do have this stickiness to inflation still, but I think most importantly for our forecast, we are expecting that you could see some softer activity data as we're getting to the middle of the year. And that is probably what gets the Fed to be cutting every meeting.
So let's put this inflation data up against what we've been seeing on the employment situation front, because last week we got a reading that, at least on the headline of the non-farm payrolls, was better than expected, but then we got those key revisions. So what does that tell us really about where the employment situation, where the labor market sits right now from your perspective?
Yeah, we had a lot of January data, January employment data, January CPI that kind of looked like this re-accelerating economy, this too hot economy. And then this February employment numbers, they were a bit complicated. We did have a stronger than expected increase in jobs in February, but we did see those revisions lower. The unemployment rate still rising. So there are these signs that the labor market is starting to weaken and continuing to weaken. And we've definitely seen hiring slow down. We've seen that in the hiring rate in the JOLT survey. We've seen that in weekly continuing claims. It is taking people longer to find work if you do lose your job. We're not seeing the big outright layoffs yet, which is of course still positive, but that would really be the last step in a weakening labor market, and all those early steps are still there.
And Veronica, to go a little bit deeper on that, what do you think the labor market is going to look like around year end?
Yeah, we honestly are expecting a recession still, where we might be one of the last people still seeing those signs. But really, this early weakening in the labor market, the slowdown in hiring, the pullback in hours worked, pullback in temporary help employment, all those early signals that the labor market, that labor demand is weakening, are still there, and those things can accelerate. You do have this non-linear element to a weakening labor market where the unemployment rate can rise relatively quickly. So we are still expecting to see that by mid-year, and we might be looking at a 5.5% unemployment rate by the end of the year.
What do you believe ultimately the Fed will kind of have on its plate in terms of the tone that it signals about the timing of its rate cut and the pacing of it as well?
Yeah, I don't think we'll learn, necessarily too much more at the March meeting that we'll have, next week. But as we're getting through the rest of this year, there probably will be, more of this trade-off between high inflation, still some stickiness to inflation, and a weakening labor market. And I do think, as we're seeing weaker activity data, weaker labor market data, they will probably be cutting every meeting. But at this point, they'll probably, keep the same kind of, implied cuts as we saw in December. We don't think there'll be much change in that March SEP next week.
All right, Veronica, always great to get your insight. Thanks so much for joining us here this morning. Veronica Clark, economist with Citi. Thanks.
Thank you.
Coming up, Bitcoin on a hot streak, edging above 71,000, briefly above 72,000. What it could mean for a great year for cryptocurrencies ahead. Bitcoin surging to another record, briefly crossing above 72,000. You can see it just around 71,800 bucks right now. Other crypto-related stocks are also seeing a boost from the recent rally in Bitcoin, driven by optimism from the SEC's approval of the spot Bitcoin ETFs. SEC Chairman Gary Gensler spoke with Yahoo Finance last week about that decision. Let's take a listen.
I thought that it was the most sustainable path forward, along with the commission to approve those. And investors got additional disclosures based upon those exchange-traded products. They get certain protections on the stock exchanges, but they should also, I would say, be aware it's a highly speculative, volatile underlying asset, Bitcoin.
All right, we want to bring in Marion Labor, Deutsche Bank's senior economist. Marion, it's great to have you here. So talk to us just about the recent run-up that we've seen in the price of Bitcoin. You've outlined a number of factors driving it. What are the biggest catalysts?
Yeah, hi, many thanks for having me today. So yes, indeed, there are few reasons why Bitcoin reached a record high. First, the ETF has just been approved last January, and we have more ETF coming as well. We are also going probably to have like a few central banks interest rate cuts, which are all approaching. The Bitcoin halving is become very near now, and regulation is also coming this year.
And one of the areas where we're seeing even more kind of coziness for it is the UK. And so where more globally are we going to expect some of the allowance for ETPs or exchange traded products for cryptocurrency, and specifically Bitcoin and Ethereum perhaps, to really continue to fuel this rally?
Yeah, absolutely. I mean, today in the UK, the FCA has just softened stance on the sector by permitting Bitcoin and Ethereum-backed exchange-traded notes. But we are also seeing this year more and more regulation worldwide. For example, in the EU, MiCA regulation will take effect in stages as well. Rules governing stablecoins will become enforceable starting next quarter. In the US as well, we have regulatory action which have accelerated despite the lack of overarching rules. We have around like half of the CFTC enforcement actions in the last fiscal years, which involved digital assets. Last year, the SEC sued Binance and Coinbase as well, and we also had the highest civil monetary penalty ordered in any CFTC, which was made against a fraudulent scheme involving Bitcoin, and it was equal to $1.7 billion. And if I look at regulation as a whole, I really see it as a net positive development for the industry. If we have a clearer regulatory framework, which might have increased corporate adoption and higher liquidity, which is probably going to result in less concentration. And ultimately, it's going to help address volatility in the crypto asset space.
So, man, do you think it's likely then that we're going to stay at these elevated levels?
So yeah, I think there are good reasons why it's at this elevated level, and it's probably going to stay high. I mean, if I look at the future, you just mentioned ETF, the spot Bitcoin ETF, which was approved, but we have also more ETF which are likely coming. The SEC first decision on the spot Ethereum ETF application is expected mid-May. And overall, this evolving ETF landscape and participation of institutional players are helping crypto mature into a more established asset class.
And just lastly, while we have you, Marion, the halving, how much of a catalyst could that be further for Bitcoin specifically? And does that mean that the global coin market cap as well can see not just a rise on the back of Bitcoin, but does that present a rising tide for the rest of the other smaller currencies?
Yeah, so you're absolutely right. The Bitcoin halving, which is the fourth Bitcoin halving actually, is approaching in about a month now. And this fourth halving will have the reward again from the current 625 down to 3.125 Bitcoins. And if we look at the previous halving events, for example, if I take the more recent one, there was a sizable 27% price increase in the months before the 2020 halving. If we look at what happened in 2016, we had a more substantial 13% gain. And if we look at the 2012 halving, prices rose by 5%. So every time we have an halving process, prices tend to rise before, around 30 days before, but also slightly after the halving. Having said that, on your question about like the global crypto market, I also think it's important to distinguish Bitcoin from the other largest cryptocurrency. If we look at the 100 largest cryptocurrencies, only 6 are at or near all-time high. So not all cryptocurrencies are equivalent. And again, Bitcoin has the largest market cap, and the market cap is also like 3 times larger, bigger than the second largest cryptocurrency, which is Ethereum.
Marianne Labor, who is the Deutsche Bank senior economist. Thank you so much for taking the time here with us today.
Thank you.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Pensions and other large institutions increasingly turning to risky leverage strategies as illiquid investments such as private equity prove unfruitful. The risk of forced liquidation hangs overhead. Here to discuss is Brandon Yarkin, who is the Universal Investments Chief Operating Officer. All right, so first and foremost, let's break down some of the risks that you're seeing right now and kind of the thesis around when some and how investors can perhaps mitigate some of that own risk.
Yeah, sure. Thank you very much for having me, Brad. So I think it's important to take a step back, and so our opinion will have some context, right? So, Universal Investments is a risk mitigation firm. So all that we do here at Universal Investments is think about and optimize risk mitigation. So clients will come to us and we offer them this kind of insurance-like payoff where we lose a little bit of money when nothing is happening, or we lose as little as possible, and then in crashes, we try to make as much as possible. So we get this reputation of being, kind of perma bears, always looking for the next black swan, right, like the black swan behind me. But that is a bit of it's a bit of misconception, because in reality, a lot of our clients use us to be long or even longer than they would be otherwise. Going back to 2022, we were probably one of the few large-scale and institutional investment firms that was tactically bullish. We went as far as putting out a broad communication to all of our clients in 2022 through Universal CIO's decennial letter, where we noted that the market was likely to go vertical because we were very concerned about sentiment being so negative, and sentiment needed to flip on its head before we would likely see a crash. So what have we seen in the period since? The market is up 50% or more, depending on which market you're looking at, and sentiment has certainly started to change. While we're always out there looking at things like private equity, as you mentioned at the start of the question, I think that that misconception of people thinking that we are always permanently bearish, when we've actually been one of the few firms that has been bullish for the past 18 months, hopefully should give it some context.
So Brandon, what could potentially trigger this? And when you're talking about a massive correction within the market, more specifically, what does that then look like?
Sure. So again, now that we have this context of portfolios that are built a certain way, we look at the financial landscape as being incredibly leveraged, right? There's a tremendous amount of debt. We also put this in our communication to clients about how much financialization and leverage has caused debt levels across corporations and governments and the like to be as big as they've ever been. And we've seen the Federal Reserve raise interest rates as quickly as they ever have. So that has specific lag effects, and one of the most visible lag effects that we've seen is on private equity. So private equity, we don't get visibility into the Blackstones and Apollos and Carlyles and the big private equity firms. What we see are people that are invested in those firms. We are risk mitigation for those people, right? For the large public pension plans, for the sovereign wealth funds. They come to us as experts, right, to help them to look at these big systemic risks that are lurking and how they can best fix them. And so with private equity specifically, what we've seen is just a growing portion of illiquidity on institutional balance sheets relative to liquidity. And by that, I mean, institutions such as pensions, sovereign wealth funds, and the like have fixed liabilities. What does that mean? That means that every year, a pension has to pay pensioners, a foundation has to pay grants, a university has to pay teachers, right? So they manage money, but a portion of it they can't touch because it's with a private equity firm, or it's in real estate, or it's in something that's difficult to sell. Yet every year they actually have to sell things to make these contributions to their stakeholders. And after this big push to be in illiquid assets, because illiquid assets arguably have higher returns, they have this volatility smoothing characteristic where they don't stocks, you see your P&L every minute, right? I'm sure a lot of your viewers are out there watching their stock portfolios as they trade up and down over the course of the day. These illiquid assets, you might not know what they're worth for a year or more. And so what ends up happening is that portion of liquid assets has continued to shrink as private equity monetizations have been negative. I'll pause for questions because I know that's a lot. But.
Well, actually, you just triggered a thought here, because even as we're thinking about some of the pension fund managers and the investment kind of hat that they have to wear in order to make sure that they are kind of getting into more liquid assets here, or perhaps rotating into more liquid assets, where are you seeing them initiate perhaps the largest, most sensible trade right now? What is the positioning that many of them are adding on over this past year, and how does that set up for kind of longer term growth of some of those funds?
Yeah, I mean, it's a great question. I mean, we obviously see what we see directly are people utilizing tail risk hedging as a means to help them with these potential very large illiquidity risks. So what happened in 2008 for a lot of private equity firms is institutions ran into this liquidity issue because of different, financial products that they were overinvested in. They add to other problems through things like securities lending. So what they want to sell, they can't even necessarily really sell in a crisis. And so they come to us and say, hey, what is the most effective way that we can generate liquidity in a crash? And, traditional portfolio construction would say, okay, well, you need to have 40% of your assets in things that are liquid, like treasuries or maybe liquid hedge funds or things like that. And what you found is because of this kind of commonality of investment process through institutional investors, they all have the same thing, and they've all underperformed or generally underperformed their benchmarks. They're all, some level of underfunding is endemic across, pension plans specifically. And it's because, every time there's some worry lurking, they end up in the wrong thing. They end up in something that is going to lower their risk, but it also lowers their returns. And one of the things that we really try to educate people on in terms of portfolio construction, and what our CEO wrote a whole book on this called Safe Haven, which I'd encourage people to read, basically says there's lots of ways you can insure your portfolio against risks, but at what cost? And most things that you do in portfolio construction have been much more costly than the risk itself. So tail risk hedging, the way that we do it, is the only form of risk mitigation that we found that's been cost effective. And those are the things that people come and look to us for.
All right, Brandon, we got to leave it there. Brandon Yarkin, Universa Investments Chief Operating Officer. Thanks.
Thank you very much.
The U.S. Department of Health and Human Services sending a message to healthcare leaders talking about what has played out at UnitedHealth Group. And they want UnitedHealth Group to take additional actions to mitigate the fallout from the cyber attack on Change Healthcare. Yahoo Finance's Anjali Kamlani is here with the latest. Anj.
That's right, Shauna. The health department sending a letter to UnitedHealth Group over the weekend saying things like the company needs to do a better job of being communicative and transparent, as well as making sure that they are making funds available for those providers whose payment systems were affected and who were basically put on pause for the longest time. The health service, Human Health Services, calling them out to make sure that the cash flow continues. Now, what we've seen develop in the last several days is UnitedHealth sort of taking a stance of this is just a payments process system in the flow of things, and other providers, including other health service providers as well as insurers, also taking a stand in helping those providers whose payments were stopped in the form of loans, as well as just available cash. Medicare as well, which falls under the health department, also doing the same thing, as well as removing barriers like prior authorization. Now, UnitedHealth has also taken a stance of being transparent in their communication, immediately notifying the cyber attack that affected them back in February, and taking the stance that they were also communicative of that. But the health department also, in that same letter, calling out the company, saying that they need to be more communicative about what is going on. And it seems like a lot of providers are also feeling that criticism about not having enough communication, not knowing what is happening with Change and how to get back online, even though the company has provided regular updates. So there's still a lot of backlash from this incident and a lot of criticism that the really large healthcare company has not done enough to mitigate the attack and help the providers that have been impacted. So it's still unraveling in an ongoing situation right now.
All right, Yahoo Finance's own Anjali Kamlani. Anj, thanks so much for breaking this down for us. Appreciate it. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
This earnings season isn't just about AI. Another big theme this cycle, stock buybacks, with Meta, BYD, Uber, and Stellantis all announcing share repurchases this quarter. So what are stock buybacks, and how should investors be thinking about them? A stock buyback is sort of what it sounds like. Companies repurchasing some of the stock they issued from shareholders, and that reduces the amount of shares outstanding in the market. Meta recently approved $50 billion in buybacks, meaning the company announced its intention to purchase $50 billion worth of stock in itself. Now, for investors, buybacks like this can be seen in different lights. On the one hand, it could be considered a bullish signal because it indicates that companies are willing to bet on their own success. But critics say that buybacks are just a way for companies to artificially inflate their own stock price. The chairman of BYD alluded to this, saying their potential $56 million buyback is meant to both enhance investor confidence and stabilize and improve company value. But to propose buybacks in the first place, companies have to have a pretty stable balance sheet. They need cash to buy their own shares. That's one reason behind investor speculation that Nvidia could be ripe for buybacks given its pristine balance sheet. While buybacks can increase share values, some experts say the real focus should be on dividends, which provide a tangible increase in the underlying value of a holding. Like dividends, buybacks return company profits to shareholders, but very important here, investors have to pay capital gains taxes on dividends. Buybacks do not trigger that tax liability.
Trouble at New York Community Bancorp puts regional lenders back in the spotlight nearly 1 year following the collapse of 3 high-profile banks. A surprise fourth quarter loss sent shares of NYCB into a tailspin shortly after the start of the year. And now the struggling lender is getting a $1 billion infusion from a group of firms led by former U.S. Treasury Secretary Steve Mnuchin as it looks to regain investor confidence. Some of the bank's troubles can be traced back to the crisis that unfolded 12 months ago. So let's take a look back here.
All right, we shall. Now, on March 8th of 2023, Silicon Valley Bank announced $1.8 billion in losses after selling investments to cover up increasing withdrawals. The next day, SVB's stock crashed and people panicked, causing a bank run. Now, by the end of the day, depositors attempted to withdraw $42 billion. Now, on March 10th, federal regulators seized SVB, not long after Signature Bank. Regional stocks plunged and President Biden addressed the nation, trying to reassure Americans that the banking system is safe.
That's right. Well, confidence ultimately had faltered. Several banks experienced issues. UBS agreed to acquire Credit Suisse to prevent it from collapsing, and First Republic got a $30 billion injection from 11 banks, but it wasn't enough. Regulators seized the bank on May 1st, and it was sold to JP Morgan Chase.
Now, the collapse of Silicon Valley Bank, Signature, and First Republic represent 3 of the largest bank failures in U.S. history. New York Community Bancorp took on some of those assets of the failed Signature Bank, absorbing billions in loans, pushed the bank above that $100 billion threshold that subjects banks to higher regulatory standards, including needing to hold more capital against future losses.
That's right. Well, NYCB says that the reason it slashed its dividend and set aside more money is just that. But loan loss money aside, the bank is under pressure because of its high exposure to commercial real estate, CRE, which we talk about frequently, which has fallen significantly in value since the pandemic and the rise of remote work. So what's the road ahead for regionals? We've got our very own David Hollerth here with us in studio. Hey, David.
Hey, Brad. Yeah, so to your point, credit is the biggest concern for investors right now. And looking through to the end of the year, it seems like, the story there is that the office area of commercial real estate is obviously an area that has structural weakness. And what banks are doing is they're setting aside a lot of money to prepare for potential losses. And the big thing there is whether or not they can predict the losses. So that's really defines how much fear could be in store for regional banks, or not at all, going out through the end of this year. So that's really where investors are focused on.
David, what do you make of the sentiment right now? I know you've been talking with a number of analysts, a number of investors here over the last several months. What sticks out to you just in terms of where we've seen the biggest pivots and why people are maybe a lot more confident in where we are today, despite the trouble with NYCB versus where we were a year ago?
Right, yeah, I think you got to highlight how unique NYCB's situation was. And as far as like how exposed they were to commercial real estate loans, specifically those in New York, that have pretty specific problems. They're very much an outlier. That being said, we did say that about the banks last year. But I'm not hearing from regulators or bank executives that they're feeling at all like this is any kind of systemic thing at this point, which is the big difference between the last year, where I think there was so much fear. And, just the idea of a bank failure, it wasn't really in the lexicon for finance or just people in the U.S. in general. And, that had been a 10-year thing where we hadn't seen such a large bank failure. So I think it's kind of dealing with that. But it seems like this is more of idiosyncratic, as they say.
All right, David, thanks so much. Great stuff. Thanks for putting in perspective. And of course, follow David Hollerth because he's closely following the latest when it comes to NYCB. Thanks, David. Well, it has been 1 year since the collapse of Silicon Valley Bank, a major wake-up call to the industry that left so many small businesses and investors scrambling to secure their capital, which ultimately led to the demise of the bank. Within a 48-hour period, $42 billion was withdrawn from that bank. In season 2 of our series Lead This Way, which debuts this Thursday in our 11 a.m. hour, Brooke DePalma sat down with the co-founder and CEO of one of the startups that was impacted by the fallout. Brooke, what did you learn? Good morning, Shauna. Absolutely. I sat down with Vanessa Pham, who founded the sauce and noodle startup Omsom with her sister, Kim Pham. Now, the two sisters found themselves in a bit of a nightmare when they began to hear whispers that Silicon Valley Bank was going under. That's the place where the then 3-year-old company had all of their capital. In our interview for Lead This Way Season 2, she recalled the fear and quick thinking she had in response to that moment.
Nothing can really prepare you for that type of, uncertainty. I had heard rumblings around the industry. I was actually at a conference at the time about people kind of scrambling to pull their money out of Silicon Valley Bank. I immediately had to figure out what our options were. And at the same time, Kim and I started working together on how we wanted to communicate what was going on to our community. And so when most other brands were kind of running away from communicating about it, we decided to come together and share what was going on. And that ultimately led to making a really challenging time something where we felt supported. But yeah, absolutely to this day, still can't even fathom how we were able to move through that. It was crazy.
And Vanessa went on to share a few hard-earned lessons learned from the collapse. Those lessons including be sure to diversify where you put your money, research the bank to understand the health and risk of a bank's balance sheet, and build out a support network and contingency plan, asking yourself questions like, is there an investor that could help you make payroll, or is there quick access to short-term capital? But Kim and Vanessa weren't alone. Its investors learned a lot from the collapse too. Ellie Truesdell, co-founder of the VC firm New Fair Partners, who's an investor in Omsom as well, she told Yahoo Finance that, she learned a lot too. She said that first, the whole entire VC industry had a quick wake-up call around balance and appetite for risk, forcing them to step back from irresponsible deal-making and frothy valuations. And she then said that she learned to be sure to look closely at every contract, partnership, relationship that they're in, and do your due diligence on how companies are managing their portfolio, including who they're banking with. But of course, the Silicon Valley Bank collapse is just one of many obstacles put in front of startups' way, especially for female and minority-owned founders. And we learned so much about how Vanessa Pham navigated all that and so much more in this new episode of Lead This Way, guys. I hope you guys all tune in.
Yeah, going to be looking forward to it. Brooke De Palma. Appreciate it. Be sure to tune in this Thursday at 11 a.m. Eastern Time to see Season 2 and that premiere of Lead This Way with Omsom co-founder and CEO Vanessa Pham. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
5 of the 7 Magnificent 7 stocks suffered declines last week, with Tesla faring the worst, off about 13.5%. And despite the Mag 7 accounting for around 50% of S&P 500 gains this year, 3 of its members are lagging behind. Tesla, Apple, and Alphabet are all in the red year to date. And once again, you see Tesla leading losses. Yahoo Finance's Jared Blickery, he's over at the big board with more. Hey, Jared.
Such as it is, sometimes we group these stocks together arbitrarily. They might be doing something similar for a limited period of time, and then they get stuck. And here we have the Magnificent 7 with huge dispersion between the contributions, among the contributions to the S&P 500's market cap. You look at Nvidia over there, it's up $965 billion. And then you take a look at Tesla, down $231 billion. As Nvidia is contributing 33% of the market cap gains of the S&P 500, Tesla is responsible for negative 8%. And sometimes math is just not intuitive that way. But the point is, besides these 4 groups of stocks that are advancing, you have these other 3. And to be fair, all 7 of these stocks have very, very different narratives. I want to point out Tesla versus Nvidia. So this is the first in class, this is last in class in the Mag 7, and this is what's happening year to date. You can see Tesla down about 27%, Nvidia up about 78%. And if I show you a 2-year chart, you can really see back when their fortunes diverged, because it was off of the October lows in 2022 that we saw this big rally, and we saw the Mag 7 kind of in lockstep, but you can see the fortunes diverging as we proceeded in the year. That was last year. Now, I also want to show some technical analysis on Tesla over the last 5 years, and what I'm seeing here is just a giant trading range with a couple of forays above and below. And so here we got above the trading range, here we got below around the turn of the year 1 year ago. But for the most part, we are in a trading range until that breaks. Difficult to see, or difficult to get excited about Tesla going in any direction or the other. Looks like I got a little bit of time, so I do want to go to our Mag 100 or Nasdaq 100 heat map so I can just check out the totals here. It's been interesting. I've been watching Eli Lilly surge ahead of Tesla in terms of market cap. And here we see Tesla at $571 billion short of AVGO. That's Broadcom. That change was made last week. And now Visa. Looks like Tesla heading for Visa's market cap next.
All right, Jared, thanks so much for breaking that down for us. Well, like Jared was saying, Tesla is the Magnificent Seven's biggest laggard year to date, but it's not the only one. Shares of Apple and Alphabet are also in the red since the start of the year. Now, this week, we are focusing on these 3 laggards and what it's going to take for the companies to turn things around. Today, the focus is Tesla, currently trading just around $179 a share, a loss of nearly 30% this year alone. Our next guest, though, saying that now could be a good buying opportunity. For more on that and what the catalyst will be, we want to bring in George Generikis. He's with Canaccord Genuity's managing director there. George, it's great to see you. So talk to us about why you think Tesla is a buy at these levels.
Well, first, let's address the reason why it's lagged. I mean, it's pretty simple. The numbers have come down. I mean, if you look at the earnings revisions for the last 12 plus months, they've been terrible. I mean, I think we started for 2023 somewhere early in that year on $6, and it came all the way down to $3. And I think we're at a period of time right now where the worries likely exceed the reality. And we had some numbers last week come out of China that weren't very good, but those people didn't take into account that the new year has been pushed into February. Also, some stuff that happened in Germany. Their plant came down for about a week because of arson, a week plus. And in the U.S., people are worried about the production of their new Model 3. And we think that the best way to kind of gauge, for the most part, what's happening with Tesla, particularly in the U.S., is to look at their prices. And they've been pretty stable in the U.S. over the last few months. So, there's a lot of wood to chop still in the quarter, but in the near term, we think that we may have overcorrected here to the downside.
They talked on their most recent earnings call, George, about the spending and some of the record R&D that they had done during 2023, which now places a lot of emphasis on bringing that to fruition in 2024 and years following now. How much of that spending do you anticipate will lean further towards the side of this artificial intelligence narrative that has started to prevail with Tesla, even though we've seen some early slippage this year, at least in the price action?
Look, we're in a little bit of a pause period right now for the stock. In the near term wiggles, we think we've overcorrected, but for the stock to really get its legs, we have to have three things happen. First, the next generation vehicle has to start to ramp, or people have to gain confidence that it's going to ramp and be successful. Second, their margins need to go up, and the most likely lever for that happening is the increase of FSD, full self-driving penetration, which leverages the AI that they've built, in addition to volumes starting to pick back up. And third, it's continuation in growth, really good growth in their energy storage business. So when you talk about leveraging this R&D that they've spent a lot on, it's two real products that come out of that, the big spending. It's number one, that next generation vehicle, which we think should start production in the second half of 2025, and continued FSD penetration. Now, we think that the FSD offering from the company at $12,000 currently is a little too rich, particularly relative to the cost of the vehicle. We think the company should cut the price of that FSD to really increase penetration and really have the margins start to turn in. If you think about it, that offering is about 100% gross margin, very, very high gross margin because it's a software upgrade.
George, we have seen, though, the price wars play out. Obviously, Tesla, far from the only automaker, one of many, I should say, that has been forced to lower the prices, obviously putting pressures on margins, very similar to what you were just saying. How do you see that, more broadly speaking, beyond Tesla, shaking out just a bit, and that pressure to the downside in terms of boosting demand? How much longer are they going to be forced to slash prices in order to drive the demand that we simply have not seen?
Well, look, there's been a pause, like I said, recently, particularly in the U.S. The price declines that we saw for the most part in 2023 is sort of ebbed right now, which for us is an indication that maybe things aren't that bad. And what the company did strategically by being that aggressive is, first of all, they get to sell more vehicles, right? Because interest rates went up and most people finance the purchase of their vehicles. So that meant that the prices of vehicles went up artificially. But second, it put a lot of their competitors on their back legs. I mean, margins got a lot worse for some of the pure play EV competitors. Sales got a lot worse for them. And even for the traditional OEMs that try to compete against Tesla, their margins got significantly worse because they couldn't compete with Tesla on price. So what we saw is, longer term, what Tesla did is put a lot of its competition on the back foot, particularly in the United States and Europe.
And so let's talk then about China, because that's one of the larger kind of lingering risks right now for Tesla. Is sentiment shifting so much in the region that there would be a longer term implication for how Tesla is able to operate and sell into China as well?
That's a great question. I mean, look, we see the real competition for Tesla long term. Look, we really like Rivian in the United States and in parts of Europe and other parts of North America. But in China specifically, there's some very, very good OEM competitors, some pure play EV companies. The company has one plant in China right now, able to produce about 950,000 vehicles. And they're running, despite this monthly volatility, they're running full tilt there. And we continue to believe they'll run full tilt in that country. So there's really good competition in China, but we think Tesla can operate that factory at relatively full capacity that leaves them in a good place in that country.
So, George, as we wrap this up, we started this segment talking about the share price being under pressure. We're trading around $179 a share today. What more specifically does that upside look like?
Look, our price target is in the 230s, and we base that on 26 times our 2026 estimates. And we think that's going to happen as volumes start to pick up next year and the year after that, based on increased Cybertruck production and the next generation vehicle. And importantly, we think that the margins will start to get better, particularly as we've seen an abatement in price reductions, at least for now, and costs continue to come down for the company. So, in the near term, we have these wiggles, and we think, like we said, we've overcorrected to the downside in the near term. But, for real outperformance, we need next generation vehicle or some visibility to that, increased margins based on FSD mostly, and continued growth in their energy storage business. Those three things will really get the stock to get its outperformance legs of old back.
All right, wiggles, good on the dance floor, not so much in the stock price. Thanks so much for taking the time here today. Canaccord Genuity Managing Director George Gianarikas, good to see you.
I see you too, thanks.
Thanks.
All right, about an hour and a half into the trading day, and let's take a look at the pressure that we're seeing across the board. The Dow now off 155 points, S&P off about 0.2%. 10 of the 11 S&P sectors trading to the downside here. Industrials, the biggest laggard in today's intraday trading action, followed by real estate, technology, and communication services. That does it for us today. Rochelle and Akiko have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Bitcoin reaching a new record high. The cryptocurrency briefly topping $72,000 for the first time, surging for a sixth straight day. We'll have more on the latest crypto action just ahead. And New York Community Bancorp drawing new attention on regional banks. The drop in the stock this year igniting fears over the sector 1 year after the Silicon Valley Bank failed. Is more risk still on the horizon? And efforts to ban TikTok in the US gaining traction among lawmakers. This legislation making its way to a vote in Congress. Will dissect the potential fallout later this hour. But first, let's take a look at how the major indices are faring this morning. Still looking at red across the board here. Looking at the Dow, currently down about 1/3%, or about 112 points. We're seeing tech and Boeing putting pressure there. In the S&P 500, down but ever so slightly there, about 0.2%, down about 9 points, relatively flat. We're seeing materials the leader there, industrials the laggard. The tech-heavy Nasdaq seeing some division there in the Mag 7. As we look at some of the pressure, Meta down more than 3.5%, Amazon and Google also in the red, as well as we continue to brace for also what we'll hear from the what we'll hear on inflation also coming up this week. So with that in mind, let's also check in on the Treasury market as well, because we are seeing the VIX up almost 8%, so some nerves there. But looking at the 5-year yield, that's currently up about 0.6%. The 10-year up about 1/3%, sitting at 4.10, and the longest term 30-year yield relatively flat as well, but sitting at 4.27. Well, stocks moving lower to start the week after the equal-weighted S&P 500 logged its 7th straight week of gains. Investors are shifting focus to Tuesday's inflation print for any hints of what to expect from the Fed's March meeting. For more on this, I'm joined by Dave Smith, Rockland Trust Chief Investment Officer. Good to see you on this Monday morning. So you note that the primary drivers for some of the volatility that we're seeing, the Fed and AI. So starting with the Fed, obviously some key inflation prints this week, starting with CPI Tuesday, PPI on Thursday. What are the expectations there?
3.1 is the expectation. Good morning, Rochelle, for the CPI number tomorrow, and we're looking at that very closely. Obviously, last week we got the jobs data, and in that data there is a measure of wage growth, and wage growth actually came in lower than expected, which was a good sign. The last two prints on CPI in the previous 2 months actually came in higher than expectation. So I'm hoping that last week results was a precursor of what we might see tomorrow, and the expectations will come in, the actual results will come in very close to expectations, and I think that would be a good thing if that's the case.
And Dave, you still see the odds of a soft landing as reasonably high, but you also know that the biggest risk to the soft landing narrative might be the risks that we aren't considering yet. How so, and how do you sort of invest with that in mind?
Well, that's a great question. There's always the risk that you don't see, right? It's the known unknown that is the thing that comes up and bites you. The last example we had of that was the pandemic. I don't think anybody was predicting the pandemic that we had back in 2020, and you just don't know what's coming down the pipe. There's things that are out in the marketplace. I've been investing for clients for 34 years now, and there's never been a time where I could sit across the table from a client and say, there's nothing to worry about. There's always something, and the things that we know about today are real, but you'll always have to also be concerned about the thing that's going to come up that no one's expecting, the sort of black swan, if you will.
It's true, because a lot of the considerations, some of the risks that are outside of the Fed's control, geopolitical concerns with China, with Ukraine, and in the Middle East as well. But in terms of some of the risks that are being priced in at the moment, do you think the market has a good gauge in terms of how things are priced at the moment?
I do. So the S&P 500 is trading at about 20 times forward earnings, and that's inside a 1 standard deviation range around the long-term average. So I would argue it's on the high side of fair, but certainly not egregiously so, particularly in light of the fact that the Fed has targeted that they will be cutting interest rates at some point in the future. Lower interest rates would imply that we should have a higher price to earnings multiple, all else equal. So I think it's you could argue that the S&P 500 is trading at a fair valuation. And if the multiple were to stay constant, the expectation going forward for earnings estimates for the S&P 500 are in the low double-digit percentages for calendar year 2024 and 25, and that's a very solid backdrop for stock market returns.
And Dave, of course, we have to talk about the other issue here in terms of volatility, which is the AI play. We're continuing to see sort of this back and forth with the Mag 7 stocks. Of course, Nvidia, its own separate story in terms of the price action and some of the swings that we're seeing. What do you make of this in terms of, are we seeing hints of a bubble, or as Dan Ives from Wedbush said, is this more of sort of this digesting of this fourth industrial revolution here?
Yeah, I think there is some examples of bubbles. I think people have certainly got infatuated with the semiconductor space, particularly in Nvidia. However, when you think back about the last time we had a technological secular change like the one that we're experiencing now with AI, in the early days of the internet, there were companies that people circled and identified as clearly the winners. In reality, though, some of those companies don't exist anymore. Netscape is a great example. That was a company, it was a really hot IPO, was one of the first internet browsers. company was off and running, and then look back today and it's no longer in existence. I'm not suggesting that Nvidia won't be around long term, but to suggest today that who the winners are going to be and extrapolate that into compounded growth for the company right now and bake it into the share price, to me, is a bit risky.
Haven't heard Netscape in a while there. You brought me back there a little bit. I do want to ask you, though, in terms of the picks that you do, like the names that you're constructive on, you point out Google, Chubb, and Pepsi. What do you like there? How are they the standouts for you?
Yeah, so in all three cases, their valuations look compelling. So in the case of Google, here's a company that's trading at a market multiple, whose earnings are expected to grow in the high teens. And historically, the company's traded at about a 20% premium to the market, currently trading at a slight discount. So we think there's opportunity for a multiple expansion. And if the stock just grows along with its earnings expectations, it certainly has a chance to outperform the broad stock market. And that's one of the things we like. The AI play there has not been as robust as everybody hoped it would be. We're reasonably confident that the management team will get that right. They've got copious amounts of capital to be able to invest in AI, either through hiring and building it themselves or potentially acquiring technology that they could bring on board and build that out. So we're confident they'll get there. And I think when that happens, there's an opportunity for that multiple to expand at least back to where it has been historically, if not before, but higher. And if you think about Meta a year ago, it was going through the same phenomenon. So we think we've seen it happen. We've seen that playbook play out, and we're confident that could come together for us as we look forward into 2024 and 25. As it pertains to Chubb, here's a company that is trading at almost half the market multiple, with a decent earnings growth and a dividend yield that's super compelling at about 3.5%. So we have a way to get to a decent return just off from the dividend, as well as a decent earnings growth that are going to really come from very strong property casualty premium prices. We're seeing, the hurricane from a couple of years ago has resulted in pretty significant pricing power, and that's playing through in the companies like Chubb. They're also benefiting from higher interest rates as their bond portfolios mature and they're reinvesting maturities into current interest rate environment. There's real benefit to them. And then finally, Pepsi, here's a consumer staples company that, again, pretty compelling valuation. Historically, it's traded at about 20% premium. Also now trading at a slight discount with a dividend yield of about 5%. So we see, again, a multiple expansion opportunity, earnings growth that's pretty considerable, and we're getting 5% from the coupon. So a pretty compelling total return in Pepsi.
Certainly some names that people might be sleeping on at the moment. Appreciate you taking the time to join me. Dave Smith, Rockland Truist Chief Investment Officer. Thank you so much.
Thanks for having me.
Well, Bitcoin's record rally showing no signs of slowing down, now topping $72,000 for the first time ever. Yahoo Finance's Jared Blickery is here with a breakdown. People who've been holding on for dear life, just rubbing their hands here. Happy to see this.
I've had a lot of people call me saying, should I sell? Because I am now break even, and I've been bullish and I remain bullish. We don't even have 100,000 in the sites yet. We'll get to some technical analysis in a minute, but I want to show what's happening with the spot Bitcoin ETFs, many of which were launched only earlier this year, except for the Grayscale one, which converted to an ETF from an ETN. It is by and far the largest, has $27.4 billion in assets. Number two, though, and three, closely on its heels, we have IBIT. That is the iShares offering there. That's $13.6 billion in size, and then $8.6 billion for the Fidelity offering. In a distant fourth place, we have ARK, that's $2.6 billion, and then a number of other contenders, which when you add them up are not that much bigger than ARK. Another interesting phenomenon going on, if you survey the entire universe of US ETFs and you look at the inflows that they've gotten year to date, we now have two candidates here, two Bitcoin ETFs among the top five, and that is huge. So you take a look at VOO, IVV. Those are the Vanguard and iShares S&P 500 offerings. You take a look at VTI, that's core all total market US. Anyway, these are very passive investment vehicles here. So for IBIT, which is iShares, to pull in $10 billion is just a phenomenal leap here. And Eric Balchunas over at Bloomberg, along with James Seifert, have been calling this the greatest launch of a new asset class ETF in forever. So here we have Tesla. I'm actually looking for Bitcoin, and here we should have our heat map, and there we go. Bitcoin up 4%. We have now eclipsed those highs, those record highs, and so we're in uncharted territory. We had a huge reaction off of 68,000. That was the former test and then break of the record high, but now it's off to the races. And one of the things I find interesting is the rise of these other coins, the altcoins, which have really lagged. There's Binance. This is over the last 7 days. Binance up 31%, Algo 25%, Litecoin, haven't seen that in forever, topping our leaderboard. That is up 19%. And those are all outshining the big guys, Bitcoin and Ethereum. And so that's really what it takes for a healthy rally. You need breadth.
It's true. Yeah, I haven't heard Litecoin in a minute. Yeah, I remember in the early days seeing them neck and neck with Ethereum in terms of making the conversation there. So appreciate you breaking all of that down for us. Our very own Jared Blickery. All right, we still have all your markets action just ahead. Stay tuned. You're watching Yahoo Finance. We're a little over a year out from the collapse of Silicon Valley Bank, a New York community bank reigniting concerns in the regional banking sector after raising its loan loss allowance. Our next guest thinks there might still be some of the same lingering fragilities that led to SVB's collapse. For more on this, we have Stephen Kelly, Yale Program on Financial Stability, Associate Director of Research. Thank you so much for joining me this morning. So first, I want to take a look at what's been happening with New York Community Bank here. Obviously, a different beast than Silicon Valley Bank, but what are some of the fragilities that this is highlighting?
Well, it's sort of the classic bank recessionary type dynamic. So, we're not in a recession now, but we had a tech and crypto recession a year ago that sort of turned into the SVB collapse. And now we're kind of in this weird commercial real estate space where it looks like there's going to be, a lot of stress in CRE, at least for the next couple of years. And so what we see are these specialized banks. You sort of can't be large and have the attention of the market and be specialized, because if you see a recession in that sector by itself, it's going to take the bank with it.
And so then as we look back on the SVB anniversary then, is it fair then to look at those lessons and compare them to what we're seeing with New York Community Bank?
It's very much a different animal. There's much less panic this time around. So this is sort of an extension, right? We're talking about fragilities that ultimately go back to a higher interest rate environment. The Fed moved very fast on interest rates in a way that the market wasn't expecting. But the market has had a year to look at banks and sort of differentiate between what's strong and what's not, and what similarities are actually, can drive a financial distress. And so we've really seen not much contagion to other regional banks, other banks in general. So it's sort of a different animal and really focused on NYCB.
And I want to talk about some of the narratives that came out of SVB, whether it was, the role of social media or some of the speed of these financial transactions now that people have been talking about. When you look at that, how accurate is that when we now have the luxury of hindsight a year later?
Yeah, it sort of doesn't stack up, right? Because modern bank runs really are institutional. They're about large dollar balances. There was a lot of hay made over Circle's $3.3 billion, right? This is not, somebody who's looking at Twitter or using their digital banking apps to transfer money out. We sort of have this sort of romantic, historic notion of bank runs as people lining up outside, but that's really not how modern bank runs work. And the social media and digital app story is really a retail story. And that's just not at the core of modern bank runs, which happen by large institutions with large uninsured deposits.
So for people who are wondering about perhaps investing in some of these regional banks, what should they be aware of, given that they are such different beasts? Some of these very specialized lenders, one that focused on, more so startups that needed more liquidity versus what we're seeing with commercial real estate and New York Community Bank.
Yeah, this is something where it really pays to understand the macro story behind the balance sheet. So you really can't have a banking panic without some sort of macro story. In 2008, it was basically the whole economy, right? The housing sector and the business model of all of Wall Street looked bad. This time around, we didn't see that. We saw sort of the macro forces really take down tech and crypto last year, and now we're working on CRE. And so following that story from, okay, what is the macro sector that's hurting and how is it going to affect the deposit side of a bank balance sheet is really the way to analyze this story. And like I alluded to, 2008 was very much a different story where you had the balance sheet and the business model of all of Wall Street basically break down. And that was never really a risk here, right? We sort of got a list of names last March, techie banks, venture capital banks. And now we're kind of looking at CRE banks, particularly with New York.
And so then, Stephen, in terms of the risks ahead and how some of the legislation that came about as a result of SVB's collapse could potentially either prevent or perhaps limit the impact of future risks in the regional banking system, what have you got your eye on there?
Well, the Fed has very much been talking about the discount window lately and its provision of emergency liquidity, right? SVB and Signature were very much not prepared to borrow from the discount window. This is not a panacea. Some folks like to think this can save a bank. It can buy them a couple days, and it's good for containing systemic risk, right? Because everybody's liquidity demands go up once there's a banking panic. So that one regulators seem very on top of, and you're hearing momentum from Fed officials on that. Other things that we heard in the aftermath, like deposit insurance, we're not hearing so much. There's basically no momentum. Obviously, Basel III endgame and higher capital requirements, not really addressing what we saw in the last year, although some folks have made it out to be sort of a treatment for what we saw last March. It really predates that, and it looks like it's in a lot of trouble politically.
Well, thank you. I know you added some important context there to some of the narratives that we've been hearing around regional banks. Appreciate you taking the time. Stephen Kelly, Yale Program on Financial Stability, Associate Director of Research. Thank you so much.
Thanks.
Well, companies around the globe are vying to be the leader in artificial intelligence, and so are countries. Now, that battle, that's widely been described as an arms race between China, is heating up. The two nations are competing for everything from design hardware to raw materials, but that's not the whole story. To tell us more is Yahoo Finance legal reporter Alexis Keenan. Alexis, I know you've been following a lot of this closely for us.
Hi, Rochelle. Yeah, so the US followed by China are really today's front runners, let's say, in that really arms race that is in the development of generative AI, those large language models. And evidence of that competition for energy, computing power, data, and models is, of course, the US's ban on exports of those very sophisticated chips to China that are made by companies like Nvidia. And then China has its own export bans on the US for raw materials that are needed to fabricate those chips. Meanwhile, both nations have subsidies, as do countries around the globe, trying to put more money into their own versions of AI development. Now, I had the opportunity recently, about a week ago, to attend Web Summit's tech conference in Doha, and I had the chance to talk with entrepreneurs, as well as financial advisors, as well as nonprofits, who are all working to bring AI into the infrastructure of, let's say, cities, municipalities, and also trying to advise their clients as to what will be the most promising types of AI use cases. And the consensus there was that today's geopolitical hierarchy that has the US in the lead there pretty significantly right now over China, that hierarchy is dynamic, that it is subject to change. And they say that some of the key things that countries can do to really make that shift are things like training of their workforce, bulking up that labor force that knows how to design and not only the hardware, but also the software. Regulations that countries are or are not passing. We know right now in the US and the UK is kind of regulation light. We don't have any formal laws on the book outside of our own existing laws, one of AI specific laws, that those things all play a role, they say. And if you take a look at a really interesting kind of complex set of information that went into Tortoise Media, it's a media organization out of the UK. They do this ranking on nations and how well they're faring in AI development. And what they look at are things like AI implementation, innovation, investment, also talent pools. And you can see there the US in the lead. Then you have China in that #2 position. Newcomer to the #3 position, Singapore, making major advancements. The UK, Canada, South Korea, there are a host of others as well. But one sore spot for the US, they say, putting US all the way down at the 28th ranking, is their environment on regulation, and also goes into that figure is the public opinion on AI. So the key area that these AI executives, they say that nations can really use to gain an edge is training the workforce. That's a big one. There was a report from The Information last week that I love that described the workforce that's able to even develop these systems, that there were so few experts that are skilled in making these large language models that they could barely fit into the bleachers of a high school gym. So I love that analogy. Yet another report from Reuters today talking about Europe being in fierce competition for labor, having to pay workers who can do this kind of software training, having to pay them millions of dollars, having to throw stock options at them, also worth millions of dollars. And then, of course, you had the DOJ in the US last week filing criminal charges against a Chinese national and former software engineer for Google, saying that he was stealing code and then sending it back for his own enterprises and other Chinese enterprises. But bottom line here is these experts say it's really too soon to know which countries will really leverage this technology to the greatest economic and societal advantage. So much more to come, but got a little glimpse overseas last week, and this was the consensus that these executives have been talking about.
I love that. I remember when everyone was like, it's coding, that's the thing of the future. And now, how quickly has that changed there when you look at the labor dynamics needed for some of these large language model workers as well? Appreciate that breakdown. Our very own Alexis Keenan. All right, all your markets action just ahead. Stay tuned. You're watching Yahoo Finance. The outlook shift for interest rates and better than expected performance of the US economy fueling wealth creation. That's according to Knight Frank's 2024 wealth report. The latest edition pointing to enormous opportunities for well-financed investors. Here with more on the next chapter for wealth is Liam Bailey, Knight Frank Global Head of Research. Thank you for joining us this morning, Liam. So I want to talk about younger generations here in terms of, some of these older generations, there'll be a lot of wealth transitioning to younger investors and younger generations as well. How should younger investors be framing this? How do they get ready for this? And what sort of numbers are we talking?
Well, depending on which source you look at, there is a lot of money to move between the generations. I mean, I think we're probably all familiar that baby boomers in particular have done well out of property and have amassed quite a significant wealth over the past sort of 20 years. And the view is that over the next 20 years, some of that money will be moving and some of it will be going to the next gen. I think in terms of asset allocations and investment priorities, I guess a lot of it comes down to what different generations will be sort of focusing on. But one of the key things we were looking at in this year's report was really, if there is a shift in wealth over time, what does that mean in terms of investment priorities? And just to give you an example, we did a survey, our next gen survey in the report, which points to younger generations being much more interested in things like environmental outcomes from their investments. So they're looking for positive environmental outcomes, etc. So there are kind of read-throughs into the investment sector, to wealth managers, and even the property sector in terms of where some of that money will be focused.
And we saw clearly the numbers for Gen Z higher than the other generations in terms of wealth transfer for 2024. Does that have the ability then to change markets, given that they do have that different focus more on some of the environmentally conscious outcomes of their investments? How might that shift some of the dynamics?
Well, it's interesting. So in the report this year, we look at, for example, say farmland investment. So there's a lot of interest at the moment in investing in farmland for obvious reasons. There's a need for people to kind of secure food production at a global level. But then when we contrasted that with the interest from investors, including younger generation investors, into things like environmental schemes, so sort of carbon sequestration, environmental improvement schemes, etc., there's a big issue, the big growth area there in terms of much more money waiting to be invested in environmentally kind of responsible schemes, I guess.
And so then, obviously, Gen Z is a generation that also gets a lot of its information from TikTok, from social media. How prepared are they for this sort of wealth transfer?
I think, I think at an individual level, obviously, there will be differences. I think there's a couple of issues, and we did a few interviews in this year's report, which pointed to just some sort of potential pitfalls. I think the good side of social media, which obviously younger generations are obviously, au fait with and very familiar with, the good side is that trends get transferred very quickly, which is great news, and means that actually new ideas, investment ideas, etc., can move around very quickly. The danger is the risk of FOMO, encouraging people to invest in something which maybe they haven't got full information on. So it isn't that younger generations are any less educated on investment than older generations. It's just that some of the tools that are being used could spill into the risks of maybe sort of slightly higher risk investing behavior.
And there is something of an information overload when it comes to, financial and investment advice out there as well. I do want to ask you, though, some of the things that are considered staples in growing your wealth, especially when it comes to real estate, home ownership. We saw that millennials seem to be more optimistic there. How much of that is based on Fed action versus perhaps having a little more money that they know might be coming to them in 2024?
I think some of those factors play out, but I also think it's something we note in the report that there's a lot of risks in the global economy. There's a lot of risks in the US and in Europe at the moment. But I think younger generations are focused on, I think that there is a confidence that their ability to actually control their own destinies and actually to control their own environment. So actually they're confident they can generate wealth. They can learn the skills, learn the techniques to allow them to actually generate their own wealth, as well as seeing positive returns on their investments. So Actually, to be fair, the survey results this year were actually very positive in terms of the attitudes of wealthy investors, but also wealthy workers and entrepreneurs.
I appreciate you taking the time to break down that report. Liam Bailey, thank you so much.
Thank you.
All right, coming up, Congress is stepping up its fight against TikTok, what it means for the app and the content creators affected. More of that after this break. Elon Musk is taking on yet another tech giant. According to a report by Fortune, Musk has plans to take aim at Google's YouTube, launching a new TV app for Amazon and Samsung users. Let's bring in Yahoo Finance's Dan Howley to tell us more. Dan, we got a bit of a cryptic tweet or X on X today, but give us the details of what we know so far about this launch.
Yeah, Rochelle, a post on X basically from Elon Musk saying coming soon to an image of what appeared to be the X app running on a TV alongside some other TV apps. In particular, it was on Google's TV app. But, this seems to be something that Elon Musk has been aiming for as far as turning X into that so-called everything app, where you'll be able to access virtually anything you need through the app itself, similar to as we said in the past, what WeChat does for users in China. And so what you would essentially be able to do is get long-form video on your TV, similar to what you might do with YouTube, The reports say that it'll be coming to Amazon's TVs as well as Samsung's TVs as kind of a native app. And so you'd be able to jump on there. And if there's a particular creator that you're interested in, you'd be able to go ahead and watch those long form videos from them. And it really would compete with YouTube as well as others, including Twitch, which is a popular streaming platform. And so, when you look at the whole of this, it really will come down to, can Musk get the big name creators that kind of drive content on the likes of TikTok, of Twitch, and YouTube to go over to X. And so, he's made some kind of nice deals for creators over there. But the question is, are there enough users to get them to want to actually go there versus the competition?
And it's certainly tough competition he's jumping into there. Appreciate that update, our very own Dan Howley. Well, here in DC, the House is pushing ahead with a bipartisan bill to ban TikTok in the US or force ByteDance to divest of the app. President Biden said he'd sign the bill if Congress approves it. The Wall Street Journal reporting that the service was caught off guard. Now, this comes amid ongoing speculation of whether TikTok's Chinese parent company ByteDance is collecting data on US citizens. Now, former Activision CEO Bobby Kotick has reportedly shown interest in buying TikTok. Now, if you remember, in the early rise of TikTok, Microsoft and Oracle also had shown interest in buying it. But the impact of a ban or sale could be more widespread than anticipated, with a number of businesses using the app to promote their products and content creators making a living from social media. Let's bring in Nadia Okamoto, August co-founder and viral TikTok content creator, to discuss more. Thank you for joining us, Nadia. So I first want to get your reaction to this, because we know that TikTok called on creators as they were caught off guard to really step up and contact the local lawmakers. How is this affecting you so far?
Yeah, I mean, when I heard the news, I was really nervous. I was definitely shocked too, because I think for me, TikTok has been such a positive force in my life, whether it be enabling so much of the work that I do on the advocacy side to destigmatize periods, but also as a business owner. I'm the co-founder of August. We're a period care brand that just launched in Target last year. And when we launched in Target, TikTok was one of the main ways that we were really driving brand awareness about that news, right? So I come at it with a lot of passion for the app and what it's enabled me and other entrepreneurs in this space. I think that for me as a creator, the majority of my income comes from this app, whether it be through brand deals, brand endorsements, and from the app directly. And so there is a big financial, outcome of having a loss of an app like this as well, which is kind of scary. I also am from a family of creators. So both my sisters are TikTokers as well. My youngest sister is paying her way through college with the money that she makes as a TikToker. And so, for us as creators, but also with so many friends who are creators as well, the results of this is, I can't even begin to explain it.
And it's interesting because the government's idea behind this is that, look, it's about protecting data that we don't know where it's being taken to, how it's being used. Are creators as concerned about that when you're putting content out there or putting information about yourself out there? Are you as concerned about how that data is being sold or used?
Not at all. I mean, I think that, I've been on social media since I was 9 years old. I made my first Facebook. I know I wasn't supposed to at age 9, but that's what I did. And so I've grown up on social media. And so this is something that I've always been well aware of. But I also think, as a user of TikTok, and even if you actually look at, what TikTok is sharing with us, there is no evidence that the data or my personal data is being shared with the, Chinese government in any way. And I think that that's something that ByteDance has not only reassured its users of, but also promised that it won't be used in that way. And so for me, honestly, as an Asian American, I feel very frustrated by some of the lines of questioning and how much TikTok has been under the microscope. And, with very public statements from many congressional leaders who I think show a lot of xenophobic rhetorics and belief from how they push on this app. I would also say that this app is just as much, I think, a part of my life as different meta social media apps are. And I think that that's something that I've always accepted and it is not concerning to me.
And something that I want to bring to your attention, because former President Trump was talking to CNBC this morning, and when he talked about TikTok, he had talked about, he was in a position at one point to ban it, saying, I could have banned TikTok, I had it banned just about, I could have gotten it done, but I said, you know what, I'll leave it up to you, talking to Congress. I didn't push them too hard, and they decided not to do it. But then he also goes on to say he knows that there's a lot of users, there's a lot of good and a lot of bad with TikTok. But then he said the thing he doesn't like is that without TikTok, you can make Facebook bigger. And I consider Facebook to be an enemy of the people, along with a lot of the media. But so this idea of if TikTok were to be banned, that everyone would flood to Meta's suite of social media, is that where you would go? And would that be as lucrative for you?
I mean, I think that, as a social content creator, you absolutely probably would have more time to be on other apps. That being said, I think that there's something really unique about TikTok, right? And I think that's why you see even Meta trying to really push towards short form video with Instagram Reels and features that really replicate TikTok. But I think that what really sets Instagram and TikTok apart is that TikTok is very much about top of funnel brand awareness, because the way you consume content on the app is through the For You page. So you're actually consuming a lot of content from people that you don't already follow, versus on Instagram and the Meta products, you're usually interacting with people and accounts that you already follow. And so as an influencer, as a content creator, TikTok is very unique in the sense that it's about growing your audience and meeting new people. It also means that as a business, TikTok is a very, very unique platform, right? So as a business, I think there are 5 million businesses now that rely on TikTok as a central way to be able to reach their customers. And for me, as a direct-to-consumer business owner, I'm very excited to also activate on things like TikTok Shop. And so to say that we would just go over to Instagram, sure, there would be less of an opportunity cost in social media to be comparing to. That being said, TikTok is a very unique app. The way people interact with the app is very unique. And I think that top of funnel, constant brand awareness, living on an explore page is something that you just don't see on other apps.
And so, Nadia, obviously, because this came as a surprise for a lot of people to see so much bipartisan support moving so quickly, President Biden saying he's willing to sign off on it, what would be the first thing you would do then on day one if they were like, right, TikTok banned in the US?
I mean, first and foremost, I think I speak for myself and so many other creators on the app that if there is anything we can do to stop this ban, we will do it, right? And from conversations that I've had with other, creators who also have millions of followers on the app, most of us had no idea this was coming, but it's very concerning. And it, for us, feels like it comes out of nowhere. And so I think that we will mobilize as much as we can. And, I've told the team at TikTok, we're ready to go to bat, put us in, coach, we're ready to go. And I think that this is absolutely something we will stand up for. In terms of what we will do on day one, if it happens that the ban goes through, is I think that we will have to really figure out how we activate through short form video content on other platforms, right? TikTok is definitely my biggest platform. I think that's the outcome of also, again, the algorithm being very much around brand awareness. I have 4 million followers there, but I have 500,000, on Instagram, on YouTube. And so I think it's about reallocating some of that time. But again, I truly think that TikTok is a unique app. It's not just another social media platform. I think especially as a business owner, the ways that you can use the app are very different. And so I would say that I try not to get too ahead of myself in planning for the eventual ban. I know we have to keep that in the back of our minds, but I think that there's a lot that we're willing to do and mobilize around to try and stop a bill like this.
Well, I know we continue to see that response. And as we said, divesting still an option there. So it's not as if a TikTok ban is imminent, but certainly worth keeping in mind as a backup plan. Appreciate you taking the time to join us this morning. Nadia Okamoto, August co-founder and viral TikTok content creator. Thank you so much.
Thank you.
All right, we've got all your markets action just ahead. Stay tuned. You're watching Yahoo Finance. Oppenheimer and the studio behind the smash hit Universal were the big winners at last night's Academy Awards, taking home 7 Oscars, including the highly coveted Best Picture award. But while traditional studios raked in the statues, streamers were nearly shut out of the Oscars this year. That's despite racking up 32 nominations. Netflix walking away with the only award of the night for the streaming giants. Joining me now are Chris Fenton, movie producer and author of Feeding the Dragon, and Andrew Stackler, Max Stacks Media CEO. Thank you both for joining me this morning. So Chris, I first want to start with you here. Of course, you're very welcome. Chris, I want to start with you in terms of, was this a surprise here to have some of these traditional studios essentially sweeping the awards here and leaving the streamers out in the cold?
Well, I thought it was a fantastic weekend for me because, quite frankly, I got to go see Dune 2 in an IMAX theater, and then I watched the Oscars last night. And it really rewarded this premium experience, this out-of-home ability to go out to theaters and see this incredible IMAX movie that was shot in 65mm film. So you created this Oppenheimer film that obviously won a lot of awards, but then on top of it, it also showcased the fact that successful box office and a premium out-of-home experience to get away from that in-home entertainment really provides the opportunity to get these massive awards. So if I'm looking at Oppenheimer this year, I might put my bet on Dune 2 this upcoming year. I might put my bet on the Mad Max franchise and even the Joker later in October. These are going to be amazingly successful films that are in the social zeitgeist and provide this really premium out-of-home experience.
And Andrew, as we do tend to see viewers now sort of picking and choosing which sort of things they want to see at the movie, something like a Dune 2 or an Oppenheimer, these huge ones that really benefit from this sort of thing. Leading up, though, to the Oscar nominations or in the campaigning there, what sort of investments do these companies and studios have to make here, and how do they tend to pay off in the long run when they do win an Oscar?
Yeah, I mean, you have to invest, you have to campaign, and the talent's a big part of that. I mean, they're out there shaking hands, kissing babies everywhere, being on a real charm offensive. And if they're not in partnership with you, it's really hard to run these campaigns. But then obviously there's a lot of advertising that goes in, that's involved in them too. And those go hand in hand. In terms of payoff, at the end of the day, these are talent relations campaigns. You want talent to bring their projects to your studio first. And talent does want to win these things, and it does impact their careers. So that is really first and foremost. They used to drive theatrical box office much more, and the theatrical rollout campaigns were designed to be in sync with nominations and wins. There's still a little bit of that. Poor Things is still in some theaters, they'll get a little bit of a bump, but the campaigns are less designed that way these days. Theatrical is less a huge bottom line than it was as well, unfortunately.
And so Chris, to bring you in here then, if you are, you're Universal, you're clearly riding high now. If you're Cillian Murphy, also riding high as well here. What should these studios do next to capitalize? And obviously, some of these productions you can still see on streaming right now. But where do you go from there to really keep up that momentum, being that Barbenheimer was a very unique year for movies?
Yeah, well, I think Donna Langley at Universal was really smart to attract Chris Nolan over to her studio to make Oppenheimer. She obviously knew he was going to shoot this in a big format. It was going to be played in the best theaters, and it was really going to expose the film to all the different categories, whether it's editing or sound or design or costume and makeup, all the way to obviously actor, director, and best picture. So that was a really smart move. Then if I look at Netflix, I might think about Dan Lin, who's one of the best creative executives in the business in my generation, and go, well, how am I going to attract people like Chris Nolan to Netflix, knowing that people understand Ted Sarandos is not prioritizing theatrical? So I might say to him, how do you get at least a couple week window on some of the biggest screens possible? Can you make an overall deal with a company like IMAX so that you at least get 5 of your best movies out on those screens so that awards voters like myself can go experience it in that communal environment, which is so important.
And Chris, just to follow up there, because we know that some of these streamers have been pulling back on some of these very expensive productions here. Do you think this might perhaps move the needle and reignite that perhaps, at least for a few select things, if you are able to get a Chris Nolan, then it is worth still spending the big bucks here, even if it is on the small screen?
Yeah, well, I would say there's probably a lot of benefit to having a couple tentpoles on your slate every single year. I mean, those bring lots of people to your platform. They prevent churn. They add subscribers. And quite frankly, they create social zeitgeist narrative around that water cooler. But then on top of it, I look at movies perhaps that were passed over this last year. I absolutely loved Iron Claw. And I think of Iron Claw as one of those movies that if it was technology-wise able to be amplified and say an IMAX screen, they should have put it out there so that awards voters like myself would have been out there seeing that film. Because if you've seen it, Zac Efron had a tremendous performance, and it was a really beautiful film with massive action scenes, even though it was done for a budget. So I think you can balance this idea of tentpoles and more artistically character-driven pieces to build the slate that still gives you those opportunities for noms and perhaps awards.
And Andrew, I want to give you the last word here, because when you look at some of the cost of some of these Oscar campaigns, people might not be aware of, can run an estimated 20 to 30 million. How do you strike that balance of sort of not wanting to appear sort of too tacky and sort of how you're pushing yourself versus that right balance there that really still resonates with Oscar voters and still gets enough attention, being that we're so fragmented in terms of where we consume content?
Yeah, that can be tough. And there are criticisms every year of this campaign was out there too much. This campaign wasn't out there enough. And a lot of it goes back to the DNA of the film and the filmmakers and the talent as a whole. Robert Downey Jr. is a great example. He was out there everywhere and you couldn't get enough of him. And he hit the right note time and time again. No, I don't think anybody was arguing he was out there too much. It is a balance of having your talent out there and also having advertising reinforce all those same messages. Four Things Run a Great campaign, their Defy Expectations campaign was great again. They always do well in phase two.
I appreciate you both for joining us, Chris Fenton and Andrew Stackler. Thank you so much. And I feel like I could never get enough Robert Downey Jr., but you know, I'm a Marvel girl, so I was already all in. Appreciate you both for joining us, and have a great Monday.
Thank you so much.
All right, well, let's get you a final check of the markets as we head into the noon hour. Still looking at red across the board, although some of that selling action has slowed down. Looking at the Dow, currently down about 64 points. The S&P 500 also down about 0.25%. Tech-heavy Nasdaq there, down about 0.5%, or about 30 points on the day. Waiting for some of that key CPI data we're expecting tomorrow. Well, that does it for now. I'm Rochelle Akufo. Stay with us on Yahoo Finance.